Hi, everybody. My name is Jackson Pino. I am the Public Affairs Manager here at Minneapolis Area Realtors, and I'm going to walk you through our residential housing market update for July of 2023. The rough agenda that we're going to go off of today, and we can always dive into curiosities and questions, so we don't have to stick strictly to this agenda. But what I have for you today is a market update, just covering over the most recent month of June, so that way you're prepared for the month ahead, given the most recent month we've completed. And then dive into my own curiosity that I found with the help of David Arbit, our research director, some interesting information about new construction in the marketplace that I wanted to share with you. And then time provided, we'll dive into some market segmentation and kind of explore that a little bit and set some of those client expectations that we were recently talking about before the recording. And then always answer questions that you all have. If you do have questions, you can put them either in the chat or through the question and answer button at the bottom of your screen. I will be watching those as we go along. But if I don't catch them in the moment, we will, of course, catch them at the end. So please stay through the entirety of the presentation and ask questions as often as you'd like. But we'll start things off with a philosophical mantra, so to speak. I'm kind of a wordy guy, if you guys know me. And I want to start things off with an ethos to center our conversation around here today. And the quote is from Albert Einstein. Time is relative. Its only worth depends on what we do as it is passing. And I picked that simply because today's market is not an absolute thing. It's not in isolation. It's relative to our experience in the market previous, and no more salient is that sort of idea than when we have had the changes of the post-pandemic or height of pandemic marketplace that we had in 2021 and 2022, and we felt kind of a slump, right? Some of you were mentioning that in the beginning before we started recording, right? But some of you might not be feeling that. Some of you might be feeling a ramp up, like Carrie Lynn kind of mentioned. It's been more busy than it was at the start of the year. And that is all to say that this experience that you are feeling as a consumer of knowledge, as a realtor, as a housing market student, right, is all relative. So keep that in mind as we're walking through these charts and relating it to your own experience. Fair? So that market update, let's jump into it. All right. First things first, let's start with sales. That perfect indicator for demand, right? Because what is demand if not someone actually closing on that home, right? And as you can see, and I will click on my little highlighter laser pointer here, we're down. This is not an unfamiliar story throughout the year, right? We are down, in this case, about 17.5% from last year, which is down again from a relative high that we saw in 2021. About 5,400 homes were sold in the month of June, and that is lower than what we have seen in the past decade, really. We're back to about the time of 2013, 2014, give or take, right? Yes, even down to 2012. That might feel like we are really in a slump, right? Especially compared to that recent 2-year, 3-year high that we were seeing in 2021. And that is similar for what we are seeing in terms of pending sales, because as we like to say here, pendings end up leading into closings, right? So this is a good forecaster for what July's closings might look like, right? And again, the story is very similar. We're down about 11%, 10.5, 11% to 5,000 pending sales in the month of June. which is, again, noticeably lower than what we have seen in recent years, particularly the highs of 2020 and 2021, right? Again, this isn't new information for you all. We've been talking about this throughout the year. We know that the big portion of this is interest rates, right? And that is the that breaking of the vehicle of the economy, so to speak, through interest rates going up. People value their money more. There's less spending, right? But we're seeing this, and I think ideally what we're seeing right now is the deepest of this impact right now, because there were some really high highs, right? And now the proverbial brake has been fully pressed, and we're feeling that now. Not only are we feeling that on the demand side, but we're seeing it on the supply side as well, right? June new listings down almost 16% to 6,700 because people are less likely to put their home on the marketplace if they don't have compelling reason to buy that next home, right? Because it is much less likely people are going to be selling off a second home or, moving in with family. They're usually listing their home because they want to buy a new home, whether that be new construction or a previously owned home, a relatively new home for them, right? And that's less likely to happen now from the last two slides we saw. So therefore, fewer listings, right? That is that new normal that we are establishing for ourselves. And I think, again, it's worth remembering these are highs, right? The 8,500, 7,900 was happening because of run-on inflation, right? People valued the home more than the money they had in the bank account, or more accurately, the money they had access to because of lifelong low interest rates on mortgages, right? We'll talk about later about the perspective to have there, but let's focus on that relative feeling. We're feeling like there's a slump there, right? Fair. Let's talk about some of these secondary metrics, those metrics that are, based off of that supply and demand that is really primary to our work here. Another great indicator, and if any of you follow our good friend Pat Paulson, we talked about this yesterday in Pat's quarterly update. Cumulative days on market is another great way we feel the speed of the market. I like to see this as the shelf life of how quickly a home stays on the shelf before it's, put in somebody's proverbial shopping basket. And boy, if you've been here for the past couple of years, you would be mistaken to see how quickly the market has been and think that is the normal, right? And comparatively to, a median of 7 days, that means half the homes left the market within a week. 12 days seems a little slower, right? But if you go back a couple years, it's twice as fast as it was in 2016 and even faster than it was, in more of a buyer's market back in the, depths of the Great Recession. 2013, 2014 is again about that balanced market point. We'll dig into that in a minute. Why is it a balanced market? But for right now, let's say that's a balanced market of about a month, cumulative days on market for the median number of homes. 12 is faster than that. We still have a pretty fast market that is moving. It looks like we got a guest visitor here, David Arbit. Hey, David. We're just jumping into CDOM and some of the ideas of, we're talking about the feeling of the marketplace, and the great way of indicating that is, cumulative days on market. How quickly are these homes selling? In addition to some other important metrics we already just covered. And I think one of the ones that everyone is always very sensitive to is median sales price. Now, we've talked about the sensitivity of median sales price in previous webinars. And in the past couple webinars, David and I have both talked about how there has been decreased price growth. And in particular for May, June's reporting of May and May's reporting of April, we saw marginally negative year-over-year price decreases, right? Of like somewhere about -0.5%. I'm happy to say that this year, reporting on June, we are back to price growth, a marginal one, but it is back up positive. We are in the black again. 0.5% increase on last year to a median sales price of $382,000 for sales in June. Now, what do I mean by price growth, negative price growth, price declines, and so on? I know some of you are unfamiliar with these terms, so it's worth repeating again, just to make sure that we're all on the same page here. What I mean, and this is a great way to visualize it, is not the absolute value of those prices, right? But the measurement of the change in median sales price. That is just as important to understand the value of the growth of the economy and the growth of demand and supply and the relationship between the two as the absolute number itself. And this, again, great chart to visualize this, right? Starting from left to right, before the recession, we were having price growth at about 7%, maybe touching on close to 9%. And then all of a sudden we hit that housing market bubble, a recession ensued, and we started seeing that first big red chunk right there, that housing price decline. Now that's what we're talking about, is the absolute value of those numbers are going down. We had a short tax credit period, which increased housing prices and then continued with that recession until we got out of that recession in 2013, 14, and so on. And you can see that we had about a decade of median sales prices growing on top of one another for each month, year over year, right? And when I am saying negative price growth, it is, think of this area. Still in blue, we're still growing, but we're not growing as quickly as we were in the beginning part of that pandemic. This area where my laser pointer is pointing at, that's where we were seeing inflation. Price growth was just, over 10%, month after month, showing year over year change being above 10%. And that height was what? Summer of 2021, where we saw almost 17% price growth. That's that height of that inflation. And negative price growth is still growth in the sales price, but we were going down until we hit those 2 months where we were both flat and negative. It's hard to see there all the way over, and I'll get my laser pointer out of the way, but we had a point of negative declines in price, and now we're back up 0.5%, but we're up. And hopefully the wise economists at the Federal Reserve have done their job appropriately, that we will start getting back to what we are seeing in 2016, 2017, stable, consistent 5 to 7% price growth. That's the idea, right? And I know it doesn't feel like that right now, but that's the aim. Quick look to see if there are any questions about that. I'm not seeing any. Feel free to jump in. I'm going to keep going, but if you have questions, feel free to put those in the chat or in the question and answer section. As we talk about median price per square foot, again, this is just a good way to control for home sizes, right? Because small homes may cost less, large homes may cost more, but this neutralizes all of that, right? Price per square foot is, again, marginally up, but meaningfully relatively flat at about $198 per square foot at the median. Fair, right? Let's talk into expectations for a little bit. The idea of original list price is a good way to get a sense of sellers' expectations of how they feel the market is going relative to them, right? And I mean that in the concrete way by saying a seller's going to come to you, right? And they're going to say, well, my home, I want to list it at this price, CMA provided and all that stuff. We still think, okay, there's growth in the economy of about 3%, 2.83%. And original list price in this instance is at a median of just short of $400,000, right? Now that begins this economic negotiation of sorts, right? Where then the buyer then puts on offers, right? And we can view that negotiation in a very eloquent way by looking at percent of original list price, right? Now, back in the height of the pandemic, in that run on inflation, there was no negotiating, right? There was such high demand, and people valued that home so much more relative to the money they could access that they said, sure, median percent of original list price was around 4.5%. And we have gone down since then, sure. But there are two important things I want you to look into with this chart. One, we're still above 100%, which means that the median number of sales here are still offering above that original list price that we're seeing, right? But it's also noticeably above what we were in pre-pandemic levels, that 97, 98, 99.5%. That is pre-pandemic norms, pre-pandemic negotiations. We're kind of locked in now to higher. Now, I'm not saying it's going to be like that forever, right? But there seems like an equilibrium that has been established here, even in that relative decline that we've been seeing recently, right? A bit of optimism there. And speaking of optimism, inventory, right? Inventory has been at a low for a while now. And this is still the case, right? We're still at 7,600 homes that were available at the end of June, which is about 12% down from last June, and at not an all-time low for June's because we had 2021, right? But a relatively low number. But relative to the decline in demand, that inventory in terms of months of supply has gone up. So again, month supply of inventory is always that inventory relative to the demand that is going on at the time. And we are finally, and I say finally because it's been almost a 2 years long endeavor, we are finally at or above 2 months supply of inventory. We have been below 2 months supply of inventory. In fact, for a period of time, we were below 1 month supply of inventory. And that is a very strong seller's market, to say the least. Now, some people may view this as, okay, demand is going down, that is not good. And I don't want to discredit your feelings on that, right? But I hope this chart shows you that, in fact, the seller's market is so strong that there is still a strong demand out there. It's just not as strong as it felt when we had that run on inflation levels of strength. David Garvis, you threw in a chat here. Months of supply of inventory has always been a great indicator for the condition of the market, buyer and seller, and provided an indicator of future price growth. However, this year we've continued to live in a market with MOS below or at 2 months and have not seen the price growth that typically coincides with these numbers. So what's your feeling on how great of an indicator MOS is in our current market, and how meaningful is it a number in our current environment? Do you still wait for that balance to arrive at 5 to 6 months? You raise a valid question there, David. And I'm not an economist, though I play one on Zoom, right? I will yield to the expertise of people who are truly wiser than David and I in real estate economics when they say 5 to 6 months is an academic standard for a balanced market. And I'll die on that hill because they've done that research, right? But I don't want to discredit the real feelings that you realtors have in the field for saying that, oh, business is down. Because again, back to that mantra we were talking about, it's all relative. It's a relative feeling, right? Thank you. I appreciate it. I mean, there are people who are true experts in this. We just love to talk and report the knowledge and share it with you all, right? Love for both Davids in the chat. But I don't want to say just because that's the academic standard and therefore you shouldn't be feeling that way. You all are entitled to making your own business decisions based off of how you're feeling in the marketplace, and don't discredit that perspective. I always want to have you, as David likes to say in a lot of his webinars, we can't control the direction of the winds, but we can always set our sails accordingly, right? And if you feel like there's a shift in the marketplace, and it's backed up by the data that you're seeing and not just a gut feeling, then act on that. Make the informed decisions based on that. Just don't do it in such a way that it is negligent of the larger perspective of charts like I'm showing you here, right? Of charts of the wider economy of where we do have an academically balanced market of about 5 months supply of inventory. Yes, it was a decade ago. And I think that speaks more to some of the policy decisions that we have of not developing enough homes in the past decade than anything else. And in fact, I think it's a great segue to dive into our kind of keynote topic for today, new construction. So thank you, David, for that great question. New construction. I often and sometimes flippantly say, cities have failed to encourage a level of development that is necessary for the economic growth that we need, right? And I don't want to just keep it to that level of 10-second soundbite, because it needs more understanding of why. What are we talking about here? And there is a great way to kind of just explore that and talk about a new topic that David wrote primarily about in the white paper that we released earlier this year, and kind of just dive into it a little bit more. So let's start off with this chart. And I'm giving you all a sneak peek into a blog post that we're going to be releasing soon. So be fair to be aware that this isn't fully public. I'm kind of giving you all the sneak peek of sorts. It's all polished, ready to go, but we're just waiting for the end of the week to really release it. So if you have questions, feel free to ask, or if you want to look into our blog at the end of the week or next week, totally fair. David has a great point that I'm not going to read out. This is David Arbit. Feel free to read it while I'm kind of walking you through this. I'll recap it at the end. What is this chart that I have hyped up so much? This is looking at the share of newly built homes. What percentage of homes that were sold on the marketplace were new construction versus previously owned homes. In the shaded blue zigzaggy one in the back, that's your monthly report. You can see some peaks of like 16%. But I wanted to simplify it here for you and give you like that teal bold center line. That is your 12-month rolling average. And you can see, excuse me, that there was a pretty consistent linear path. And boy, as a stats nerd, I do love linear trend lines. They are, that's like gold standard for me, by the way. But anyway, good, solid, predictable linear trend all the way up until 2021. And then we got this little U-shape thing going on. And yes, pandemic, inflation, all that, you all know it, right? But the question here is, if you were to, imagine that the pandemic didn't exist and just continue that trend line up, are we catching back up to what should have been? Or is there something else going on here? Because man, that's ramping up really fast from a 9.7% share of homes that were new construction to 11.5% share of homes, right? And I think that type of curiosity is always worth digging into. So let's look at this from a different angle. Let's actually look at it in the context of previously owned homes versus new construction, right? And that's what this is, okay? So now I'm showing you the Lego blocks, so to speak, of all the homes for each month that build up to be new construction, and all the homes that were previously owned. And you can see that it isn't so much that new construction is starting to balloon up as that last chart may have indicated, but really it's a lot more flat. And what is actually happening here is that previously owned homes, the closed sales of previously owned homes has meaningfully, I hesitate to say the word dramatically, but more dramatically decreased than new construction. And new construction relatively looks kind of stable and flat, right? So let's go back. We see growth, but again, that's growth relative to what? This is what it's relative to, a big drop off, right? And I hope that this shows you it's more than just something interesting. It's showing you what's actually happening in the marketplace here, right? Previously owned homes, closed sales are the ones that are much more sensitive to those economic drivers of, mortgage interest rates, the Federal Reserve, all that sort of stuff, right? Than new construction is. Now, that's not to say that new construction isn't impacted at all, because again, this scale is big. It's the entire marketplace, right? Let's take a look at what the new construction just by itself, because you can kind of see it is declining a little bit here. If you got the keen eagle eyes of me and David Arbit, you do. So let's get rid of previously owned homes sales and just look at here in beige, closed sales of new construction, and you can see it has been going down. Again, a very satisfying linear trajectory here, and it's been going down ever since when? The summer of 2021. Now that is really interesting because remember, interest rates didn't start getting impacted until the beginning of 2022. So what's causing the demand for new construction to go down since the height, I will say arguably, the height of inflation in the pandemic, right? I have an idea here for you. I think again, height of consumers being able to stretch their dollar and get homes for the biggest bang for their buck, so to speak, right? Well, if they're really trying to stretch their dollar further, and we know that the median sales price for new construction is on average higher than that of previously owned homes. If they're really trying to stretch their dollar further, they're going to prefer that previously owned home because they can get more bang for their buck there, even more so, right? So that is an indicator there for me of what's going on. And then add on at that point 2022 inflation, all that sort of stuff. But to continue that story on, you see, as I've added here, new listings. Again, that supply driver here. This is new listings of new construction in blue. And you can see that prior to the pandemic, these lines were parallel. They were both going up relatively. And you can kind of see even when they start to dip down a little bit, there's a little bit of dip down, dip up, that sort of thing, right? They are almost constructively designed to be in parallel, because basic economics tells us that when the consumer demands more, there's going to be more supply to meet that demand. There's less demand, they will supply fewer to keep price similar, right? And that is happening all up until the beginning of 2022, right? Divergence is what we're seeing here, right? Increase in supply, but a decrease in demand. Again, David and I have come up with a story that we believe is fairly compelling. And I think it all centers around, yes, interest rates, but more importantly for new construction, it is supply chain disruption. They thought, okay, the market's hot, 2021, big market increase. Yes, not necessarily in new construction, but the overall housing market. And we want to meet that demand. But just buying the material alone, huge setback. Some of you know this better than I do, right? And that on top of interest rates for mortgages going up and the cost of those goods going up, even on top of the shortage of those goods going up, right? Means that they've had a 1.5 year long diverging supply from that demand, which again is interesting because in this entire context, we've been seeing median sales price go up. Again, this is median sales price in the Twin Cities. In green, there's new construction. And overall median sales price is here in teal. This is a month-by-month view, and I chose a month-by-month rather than 12-month rolling average to show you specifically. Look at this. Look at 2022 to 2023. That is not that seasonal vicissitudes, so to speak, that seasonal change that we normally see. It's kind of like its own table right there. And it's been increased. Why? Because of interest rates, not only on the inflation from the housing market, right? But also inflation on the goods to build these homes. Because remember, the overall market doesn't have to actually worry about the price of materials. They're already there, it's been built. But the new construction industry has to worry about 2 types of inflation, right? Super interesting stuff, right? There's the highlight right there. I knew I put in that circle. All right. Now, another way to view this, again, looking back to that change in median sales price, is another good way to see how powerful that circled area really is, right? You ready for it? Bam. Look at that. So what we're seeing here is change in median sales price. And we'll go back. New construction is usually median sales prices above the normal, above the overall market, right? But the overall market in this new chart grows at a rate that is higher than the new construction, or at least it used to, all up until these supply shortages, inflation impact started having a double compounding effect on new construction, causing that price to balloon. Now it hit a peak, right, of about 14% year over year change in median sales price, and it started to dive back down because that price was just unattainable. And I think this speaks to those feelings that we're talking about. Again, it's all about time and context and that moment that you're feeling right now and anchoring it to something. And me being the market research guy that I am, I want to help you anchor that in evidence and not necessarily in feeling. So I'm going to try to do that now, right? Because it does seem high. This is my attempt at that. And I'm going to hang up on whoever's calling me. All right. So we are lucky enough now to officially have 2 decades worth of data here through InfoSparks, our MLS data downloads, and all that sort of stuff. And because of that, I can kind of show you some really interesting information about new construction and price breakdowns. Okay. So there's a lot going on in this chart. First off, 3-bar colors mean 3 different decades. Last month is in that navy blue, that Mara blue. A decade ago, June of 2013, is in that green. And 2 decades ago, June of 2003, is in that beige. And what I want to impress upon you is that some people are feeling new construction is more unattainable than it ever has been, and it's unfair, and we'll get to that, right? But I want to dispel some myths here. This is the price breakdown of homes that were sold. Again, the share of new construction broken down by price, adjusted for inflation. It's all in June of 2023 dollars, okay? And if you were to take the price breakdown of new constructed homes that were sold in June of 2003, the home breakdown would look like what we see here in beige. The lion's share is going to be, $250,000 to $1 million. Again, that's the market, right? But it's centered around mostly $350,000. That's the median here. The highest percentage breakdown is above $500,000 at 39%. Go forward a decade, June 2013. We were coming out of the recession. We were in that sweet spot of a balanced market, right? For a time. And you can see green looks like a little bit more of like an even distribution. It kind of looks like a triangle, like an equilateral triangle, instead of like leaning to one side. The median home and like the highest distribution of homes was in that chunk of $350,000 to $500,000. So that distribution of new construction, mind you, new construction was a little bit more evenly dispersed, more egalitarian, and certainly you don't see a noticeable share of homes at $120,000 to $150,000 in new construction, or just below $250,000. You're seeing more green in this area than anything else, right? Now, shift to today, or more appropriately, last month, right? We're back to similar to what we saw in beige, but even more so, right? $350,000 to $500,000 is that highest breakdown. It's at 50%, which is more, use air quotes here, more attainable than it was in 2003, but we're not seeing that that share of $250,000 to $350,000 in new construction like we were 2 decades ago. Certainly not what we were a decade ago. Where is that showing up now? Pre-luxury and luxury. 500,000 to $1 million and above, right? That is a more accurate description of what we're seeing, right? It's not more unattainable than it ever has been. It's as unattainable as it has been in 2 decades past, but relative to, that sweet spot of 2013, 2014, 2015, yeah, it feels more unattainable. It really does. So you wouldn't be, you know, you wouldn't be wrong for feeling that way if you've been in the business for 10, 15 years, right? I know we're coming up close to time, so I'm going to go relatively quick with more of these. Again, that idea of a shortage, this is a great way to visualize that shortage. Blue here is the inventory that we've had for, last month of June, June of 22, 21, 20, and so on. And the gray kind of invisible area is the level of inventory we would need to get to 5 months supply of inventory, i.e. that balanced market that we're talking about. That is the bigger issue. Yes, unattainability, what we're seeing here is an issue. I'm not doubting that at all. We need to see more options like green than we do in blue right now. But the bigger elephant in the room is that blue doesn't fill up any of these gray bars to the top, and it hasn't for years. And more accurately, it hasn't for certain price points. We are, again, this is the amount we would need to meet the demand that we have, so that way we would have 5 months supply of inventory, and we would have to, almost double our inventory overall. But look at some of our a competitive market, that market rate, 300,000 to 500,000. Man, we are losing out month after month. We need 6,000 more homes that should have been sold, and not to mention the affordable rates, right? Now we're doing a little bit better in that pre-luxury area. In fact, the luxury, we're overbuilding, again, big air quotes there, right? Our needs being met, I think, is more appropriate to say. Our need is not being met here. So in terms of meeting needs, client expectations, right? What does this mean with 10 minutes left? Again, main takeaway here, housing affordability has been going down, right? Relative to this index here, yeah, we've been going down in recent months. That feeling is valid, right? And your buyers feel this in no more concrete ways than talking about monthly payments, right? We were getting a heck of a deal for the beginning of that pandemic. Like, almost all these charts that I'm showing you, as soon as January 2020 comes around or March of 2020 comes around, things start skyrocketing or falling off the cliff. Change happens in some sort of way. Not here, not in this area. We're getting the same sort of great deal that we were getting, $1,600, $1,700 a month, monthly payments for the median priced home, for the median family income. That's obtainable, And then interest rates started to kick in. Now they're feeling this, $1,100, $1,200 more a month for that same price home with the same income, right? That feels different. And that feels like, man, this isn't for me. My options are limited now, right? I'm getting a raw deal. And I want to dispel that myth a little bit, right? It's not that you're not getting a raw deal. It's not that you're getting a raw deal anymore. It's that you aren't getting the deal of a lifetime that you were in this kind of laser point circled area. Why? Because of what David and I like to call the great mean reversion, right? Prior, so the bounds here, the upper bound of 5.8% year-over-year appreciation, again, academically is an upper limit of what we should expect homes to appreciate at, and 5.4% year-over-year appreciation is that lower bound of sorts, right? And we want the blue, the actual average sales price, to fit somewhere in between those bounds, right? And there was higher than what probably should be reasonably priced at the beginning. That housing bubble was a clear indicator. You can visually see that bubble here above the red line, and boy, did it fall, right? It fell below that lower bound. And from 2012 on, we've been below that lower bound. And that is what we've gotten used to. Again, time is relative. That feeling, that moment, and what you're doing with it, as Einstein was saying, is relative, right? And we've been getting a deal for a decade, and it feels like the norm. And now, because of interest rates, you can kind of see with that recession indicator here, we rocketed back up to just at that lower bound in 2021, 2022. And that feels like we're not getting our fair shake anymore, right? But it's really like we're not getting that deal of a lifetime, right? We're catching up. Now, what does this mean for forecasting for 2023, right? NAR says that we should expect home prices here in the center to be about even. Don't expect, the percentage increases that we were seeing in years prior, right? And in terms of unit sales, we might even go down. Dollar volume, we might go down. And they're not the only ones, right? Realtor.com, Freddie Mac, Fannie Mae, Zelman, they're all giving a wide range, right? Some are more conservative and some are more optimistic than others, but they're averaging out about flat. And guess what? If you love your InfoSparks, you go to InfoSparks right now and you look at median sales price for the Twin Cities, and you change that filter to a 6-month, i.e. the year to date right now, that's 0. So that collective average of all 7 forecasts is about on. I like to say, Lawrence Yun got it probably the most right. But what does that mean? It's not all, again, not all doom and gloom, right? We are doing better than some markets, not as good as others, and there are pros and cons to each of those situations, right? We're here in pink, right? This is the Case-Shiller Home Price Index, inflation adjusted relative to January of 2000, right? We're up, right? That's great. But more importantly, again, solid, predictable, stable, linear trajectory, right? We have gone down as everyone else has, right? But we aren't declining like some of the West Coast cities. Example here, San Francisco. Yes, we didn't see the high highs, but we're also not seeing the sharp drop-offs. We aren't doing as high, we aren't performing as well as the US average here in blue. And again, the coastal cities here, New York in red, we're not performing as high. But within the region, take Chicago, for instance, right? We're performing better than Chicago, right? Similar linear trajectory, but in terms of this Case-Shiller Home Price Index, we're doing all right. So there is optimism here, right? Mortgages, let's look into mortgage rates with a few minutes that we have left. Looking into the averages of NAR, MBA, Fannie Mae, and Freddie Mac, right? They said Q1's average of all 4 of these would be around 6.35, and then in Q2, 6.5, and we'd start getting back down below 6. Seem to be a little bit off, right? We're at about 6.7 now, right? So Fannie Mae, Freddie Mac seem to be a little bit more on the nose with their projections than NAR and MBA in terms of mortgage rate projections, right? And we see that by looking at Fred, the Federal Reserve in St. Louis. Their 30-year fixed rate mortgage average again is 6.71 as of this week. And I would anticipate with what I'm hearing about the Federal Reserve potentially doing one more rate increase, it's going to be a marginal one. We might see this continue, but I think the skyrocketing has mostly passed us. If it does go up, it's going to go up marginally, right? And remember, yes, mortgage interest rates are high right now relative to the past couple of years, but this has been the case before. 2002, and yes, I understand 2 decades ago it was similar, right? But boy, you know, this isn't the 80s, this isn't the 70s. Yes, it's up, but it's not as up as it has been. And to kind of close things out and answer any questions that you might have, one more thing, as interest rates go up, right, we do see an increase in cash deals, right? So as a percentage of all closed sales, cash deals have been going up. We're at 16.6% of sales were made in cash last month. And that is the 4th time that it has increased. So keep an eye out for that. That is something to be aware of. And with that, we are out of time. So I'm going to stop there. Say thank you for sticking with me. If you have any questions, more than happy to answer them now. I'll give you a couple minutes just to either take down my contact information or type that question in the chat. Thank you, David and David. You guys should, you know, like the Muppets, you know, could do that kind of word, David and David, that sort of thing. Austin, thank you. All right, I'll let y'all go. I appreciate you taking an hour of your day. As always, I will share these slides. I'll share the recording on YouTube. And until next time, enjoy the month of July. My best wishes to you all. And I will see you all in August for our next monthly housing market update. Take care, everybody.